People assume the economy is whatever the latest headline says, but your real economy is simpler. It's whether your hours get cut, whether credit gets tighter, and whether the prices you pay keep climbing. This week, a big mood gauge moved hard. The Conference Board's Consumer Confidence Report for January showed a sharp drop, landing in the mid-80s. That does not automatically mean a recession, but it can change how businesses and banks behave, and that is what can show up in your wallet. By the end of this video, you'll be able to do 3 practical things. First, you'll understand the simple chain from a confidence drop to jobs and credit. Second, you'll know who usually feels it first. Third, you'll have 3 concrete signals to watch, with where to check them and what direction matters, plus a 2-minute checklist you can run on your own money. Picture a renter who is doing okay, but only if everything stays on schedule. Bills are paid, but there's not much extra. They carry a few $1,000s on a credit card, and they're planning a car purchase in the next few months. For them, the risk is not a stock market headline. The risk is a lender quietly tightening or a job schedule quietly shrinking. So what happened in plain English? Consumer confidence is a survey. It asks households how they feel about business conditions, the job market, and their own income outlook. When confidence drops, it usually means people feel more cautious. They delay big purchases, they pull back on extras, and they talk themselves into waiting. The key detail is that confidence has 2 sides. There is the right now feeling, and there is the next 6 months feeling. When the future side breaks, businesses tend to react faster because it changes planning. You don't need everyone to stop spending. You just need enough people to hesitate. Now, let's translate that into the chain that matters. A confidence drop can hit in 3 waves. Wave 1 is spending behavior. If more people delay a purchase, a business sees slower sales. To protect margins, businesses can discount, reduce inventory orders, or cut hours. That is how a survey turns into a schedule change. Wave 2 is employer behavior. When revenue feels less predictable, hiring plans get cautious. Overtime gets trimmed, temporary roles don't get renewed. Layoffs are later, and they're not guaranteed, but hours and hiring often shift first. Wave 3 is lender behavior. Banks and lenders care about 2 things. They care about whether people can repay, and they care about whether the rules are changing. When confidence drops, lenders watch for early stress and delinquencies and late payments. If they see even small signs, they can tighten standards before the public feels it. Here's a worked mini example to make this feel real. Say a household spends about $4,000 a month. If they pull back by even 5% for just a few months, that is $200 less spending each month. Multiply that across thousands of customers for a local business, and suddenly the owner is not adding staff. They might cut 1 shift per week instead. 1 shift is not dramatic, but it is real money. This is where the economy can feel worse than the numbers. The numbers might still look fine in big aggregates, but households feel the squeeze from timing and risk. If your credit card interest is high, you feel any shock more. If your income is stable and your buffer is solid, you feel it less. Now, let's talk about the part that surprises people. Confidence is not a law of physics. It can bounce. Bad news, political noise, and price spikes can push it around. So, one reasonable read is that a confidence drop is a warning light, not a verdict. You watch what the real world does next. And that real world is markets and industries reacting in ways you can actually see. Retailers watch foot traffic and online conversions. Travel and big-ticket purchases usually soften first. Companies may respond with promotions. That can be a relief for prices in the short run, but it can also be a sign demand is wobbling. Banks watch repayment behavior and loan demand. This week, the Federal Reserve held its policy rate steady in the 3.5% to 3.75% range. That matters because it keeps borrowing costs from falling quickly. When lenders don't expect quick rate relief, they can become pickier about who gets the best deal. So, where does product repricing show up? For most people, it shows up first in credit, then in cars, then in housing. Credit card annual percentage rates are usually slow to fall and quick to rise. Personal loan offers can change fast because lenders can tighten approvals or raise rates for riskier borrowers. Auto loans can reprice based on default risk and dealer incentives. Housing is a different animal because mortgage rates move with bond markets and expectations, not just the headline policy rate. Here's the part most people never get told. Lenders do not just change the interest rate. They change the box you have to fit inside to get approved. When conditions feel safer, that box is roomy. You might get a higher limit, a lower required down payment, or a loan approval that feels instant. When conditions feel riskier, the box tightens. The lender might require more income documentation. They might lower the maximum amount they will lend. They might keep the same advertised rate, but reserve it for the strongest borrowers. This is why two people can see totally different offers in the same week. Imagine two borrowers shopping for a $25,000 car loan. One has low credit card balances, steady income, and a history of on-time payments. The other is using most of their available credit and had one late payment last year. If lenders get cautious, the first borrower might still see the best rate. The second borrower might see a rate that is 2 or 3 points higher, or a shorter term, or a larger required down payment. That spread is the tightening. It often shows up before any headline says credit is tight. And credit tightening does not always look like a rejection. It can look like a smaller limit increase. It can look like a balance transfer offer disappearing. It can look like a personal loan quote that is suddenly more expensive. It can also show up in housing in a quiet way. More paperwork, stricter income checks, or fewer exceptions for borderline files. Now connect that back to confidence. If households feel nervous, late payments can rise at the margin, not because everyone stops paying, because a small group runs out of slack at the same time. That is enough for lenders to adjust. Another reason the economy can feel worse than the top-line numbers is what I call the spread effect. Prices might ease for people with strong credit and stable income, while getting worse for people on the edge. So averages look stable, but the experience diverges. If you are carrying a credit card balance, this is where the drag becomes obvious. Credit card interest is usually tied to short-term rates plus a markup. When the Federal Reserve pauses rate cuts, that means there is no automatic relief coming next month. So if lenders also tighten due to higher risk, you can get the worst combo. Rates stay high and approvals get harder. A common mistake is thinking that a confidence drop changes your life through one big event. It is usually the opposite. It is a pile of small frictions. A promotion disappears, a fee shows up, a deposit requirement goes up, a manager stops offering overtime. Let's give this a simple, testable translation. If your cost of borrowing rises or your access to borrowing shrinks, you will feel tighter even if your paycheck stays the same. That is why confidence matters for regular people. Now, let's bring in the market response piece in a practical way. Businesses respond to weaker confidence by trying to protect cash flow. They can cut costs or they can chase demand. Chasing demand often means discounts. Cutting costs often means hours. The split depends on the business. A big retailer might run promotions. A restaurant might reduce shifts. A construction company might delay hiring. None of that is guaranteed, but it is the mechanism that connects a survey to your week. And there is a counterpoint that matters. Sometimes confidence drops, but spending does not collapse. If wages are still rising, if households have savings, or if big expenses like rent have already locked in, people keep spending out of necessity. So, the practical way to frame this is not confidence fell, so disaster. It is confidence fell, so watch whether behavior changes. That's why the signals matter. They are the bridge between mood and reality. So, let's turn this into 3 signals you can actually watch without living on financial Twitter. Signal 1 is the weekly jobless claims number. Where to look? The U.S. Department of Labor release every Thursday, or the same series on Fred if you like charts. What direction matters? 1 week means almost nothing because seasonal noise is real. What matters is the direction over 3 to 5 weeks. A steady climb is the early warning, not a single spike. Typical timing. This is one of the earliest labor signals. If something is breaking, claims often move within weeks, not months. To anchor this, think of our renter again. If claims start rising for several weeks, that is a hint the labor market is getting less forgiving. It does not mean they are losing their job. It means it is smarter to treat your income like it could become more variable, even if the headline unemployment rate still looks calm. Signal 2 is bank tightening, and the cleanest public window into that is the Federal Reserve's Senior Loan Officer Opinion Survey, also called SLOOS. Where to look? The Fed's SLOOS page, which comes out quarterly. What direction matters? You are watching for net tightening of standards on consumer loans. Tightening means banks are making the approval box smaller, even if advertised rates barely move. Typical timing. This is usually a 1 to 3 month lead on what regular people feel, because banks adjust standards and then you see it in approvals and offers. Back to our renter planning a car purchase. If the slews shows more banks tightening, the practical takeaway is simple. The best deals get reserved for the cleanest files, and everyone else sees higher pricing or stricter terms. So, the wallet impact shows up first in L2, borrowing access, and then in L1, interest cost, even if the economy headline is still arguing about growth. Signal 3 is a personal signal because credit tightening often hits your accounts before it hits a chart you watch on YouTube. Where to look? Your credit card app and any credit monitoring screen you already use. You are specifically checking available credit, promotional offers, and whether your limit changed. What direction matters? Fewer balance transfer offers, lower promotional limits, and a limit that does not grow with your income are all soft forms of tightening. So, is a pre-approval turning into, we need more information? Typical timing. This can change within days to weeks, because lenders can adjust offers quickly when risk feels higher. Here is a common misread. People think credit tightening is only when you get rejected. In real life, tightening is often when the same person gets approved, but on worse terms, or they get approved for less than they expected. That difference is what makes the economy feel worse than the average number. Now, let's connect those 3 signals back to the January confidence drop so you have a clean mental model. The Conference Board reported the Consumer Confidence Index fell sharply in January to 84.5, down from a higher December reading. That is the mood piece. The signals are the behavior piece. If confidence falls but claims stay stable and banks do not tighten, your personal world might barely change. If confidence falls and claims start rising and banks tighten, the frictions show up fast. That is when regular people feel it first through hours, credit, and payment stress. Now, you might be thinking, what about the Fed? Today, the Fed held rates steady in a 3.50% to 3.75% range. The reason that matters in this story is not the headline itself. It is that high borrowing costs can keep pressure on households that are already stretched. So, if confidence drops and lenders tighten, you do not get automatic interest relief as a cushion. Let's make that practical with a simple number. Example. Say our renter has a $3,000 credit card balance at a high APR. Even a small increase in the rate or losing access to a balance transfer can change their monthly breathing room. If their job also trims hours by 5%, that is the double hit. The combo is what pushes people into late fees and missed payments, not one dramatic headline. Now, options, not directives, options, and I'll organize them by one variable that actually matters, timeline. If you have a big borrowing need in the next 0 to 90 days, like a car purchase or moving costs, the main variable is approval risk. Options to consider include reducing your utilization before you apply, documenting income cleanly, and shopping with more than one lender so you see the range of terms. Upside, you reduce the chance you get stuck with the worst pricing. Downside, it can feel like busy work, and it might not change the outcome if your file already qualifies for top tier. If your big need is 3 to 12 months out, the main variable is flexibility. Options include building a slightly larger cash buffer so you can choose timing and keeping debt growth flat so your profile does not worsen quietly. Upside, you buy time, which is power when terms shift. Downside, cash buffers can feel slow and boring, and that is exactly why people skip them. If you do not have a borrowing need, your main variable is stress insurance. Options include making sure auto pay is set correctly, knowing your true monthly minimums, and having a plan for an income dip that does not start with a credit card. Upside, you are harder to knock over. Downside, it does not feel urgent until the week it becomes urgent. Now, let's do the 2-minute checklist. This is the open the apps, check the lines part. 1. In your bank app, look at your last 30 days of bills and list the 3 largest that are non-negotiable: rent, car payment, insurance, child care. 2. In your credit card app, check your utilization and your next due date and confirm auto pay is actually on for at least the minimum. 3. Check your available credit and whether any promotional offers are active, like a balance transfer window. If offers vanished, that is a tightening hint. 4. check your work schedule or hours for the next 2 weeks. If hours are wobbling, treat that as a real signal, not a vibe. 5. Check one emergency friction, overdraft settings, late fee settings, or a calendar reminder for due dates. One fix prevents a cascade. Bring it back to the renter. If they do those 5 checks, they will know whether their risk is mostly an income problem, a timing problem, or a credit access problem. And that matters because each one has a different first move set of options. Now, I want to close this chunk by answering the question people ask in the comments. If confidence fell, does that mean prices finally drop? Sometimes, in some categories, and usually with a lag. But essentials can stay sticky, and housing is its own world. The better question is, will your personal costs go down faster than your personal risks go up? That is why we watch the signals. Next, I'm going to map who gets hit first and how to spot the early frictions before they become a late notice. Here's who usually feels it first when confidence drops and the world actually tightens. First are households with thin cash buffers, not because they did anything wrong, because a small timing slip becomes a fee, and a fee becomes a bigger slip. If you are living close to zero, the first hit is usually L3, budgeting and saving systems, because the system has no slack. Second are borrowers who are already using most of their available credit. In a tightening cycle, the cost is not just the interest rate, it's the loss of flexibility. Balance transfer offers dry up. Limits stop growing, and approvals lean harder on clean file signals like low utilization and stable income. That is L2 and L1 showing up at the same time. Third are people whose income is variable, even if it is good income, gig work, commissions, overtime-heavy jobs, seasonal roles. When businesses get cautious, they adjust at the edges first. Hours, bonuses, and scheduling. That's L5, jobs and income stability. Now, let's give you one clean way to use the signals without doom scrolling. If weekly jobless claims are flat and your hours are stable, treat the confidence drop as noise that might still affect promotions and pricing, but not as an immediate personal crisis. That's when the best move is simply to run the checklist and tighten your own timing. Make sure bills and minimums are automated and your buffer is not imaginary. If claims are trending up for several weeks and you see any soft tightening in your own credit offers, treat that as a real change in the environment, not panic, just reality. That's when it makes sense to protect flexibility, keep utilization from creeping, delay optional new debt if timing is not ideal, and increase your buffer, even slightly so you can choose when to act. If claims are rising and your personal income is wobbling, the priority becomes preventing cascading damage. Late fees, overdrafts, and missed payments are the stuff that turns a temporary squeeze into a long recovery. So, your best options are the ones that reduce friction fast, confirm autopay, call and ask about hardship options before you miss, and choose the simplest way to lower the monthly minimum drain. Now, a final correction that keeps you grounded. Confidence is a signal about how people feel. Your life is driven by what happens next. The point of today's video is not to predict a recession. It's to give you a dashboard. You have a mood gauge, which just fell sharply in January. You have a labor gauge, which you can track weekly. You have a bank behavior gauge, which updates quarterly. And you have a personal gauge, which updates every day, your own accounts. If you take nothing else, take this. When the economy feels worse, it's often because friction increased, not because the world ended. Friction is higher borrowing cost, tighter approvals, and less predictable hours. Once you see that, you stop arguing with headlines and start managing the real mechanisms. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered or the one part of today's video you want explained even simpler.